Welcome to the daily update, where I'll go over the action in the market for Wednesday, December 4th, and we'll see how things look for Thursday, December 5th. Another day, another new all-time high, and we're getting some encouragement because we're seeing the mega caps, we're seeing large caps, we're seeing semiconductors all up, and that really helped the S&P to set a new all-time high. We also set another all-time high with the Dow, the Nasdaq 100. And so things are looking pretty good, but as always, there are some areas of weakness that we're seeing because we're kind of shifting back to what we saw last summer. And I mentioned this in yesterday's video where it's the really big stocks that are driving the indexes right now. And that's fine because we focus on the S&P 500. And if it goes up, we hit profit targets with strategies that are implemented, which that's what happened on Wednesday. And we continue to look pretty positive. But if you look at the rest of the S&P, they're not participating. And if you look at the broader market, it is showing at least some signs of weakness. And I'll go through and talk about that. Okay, first, the SPX Investing Program. It's up, it's going, it's free until the end of 2024. Check that out. I mentioned some trade ideas. There's an additional video that I do there where I have some long-term, intermediate term, and short-term suggestions just to give you some ideas based around strategies that I teach in another course that's in the program, the strategies course. And that just, what I show in that video is just the surface of what the strategies that are available. These are just some more basic ones that just because they're basic doesn't mean they're not effective. They can be very effective. And if this is something that's newer to you, this might be something that you want to explore. But we look at all different time frames there. There's a link that will take you to the website, a link that will take you to a video. You can send me an email if you have any questions, and you do get immediate access to all the videos as they're posted and additional videos that I don't post on YouTube and Rumble. Also, the daily video, that is where I really focus on my analysis and commentary, where I try to get the bigger picture by the weekly videos that I do. Okay, let's go back and talk about what happened and then look at some charts here. We did have a higher open. Now, it looked like a gap, and that's really because Tuesday's session was kind of anemic as far as price movement once we got open there. And so it didn't make it very difficult for price to get above R2, which is what happened at 60, 64. And then we just went up to the 60, 75 level and just kind of stayed there. You notice how we hang out around these whole numbers, 50, 75, and so forth. Then as the day went on, we fell back down to R2 before climbing above R3. And again, because Tuesday's session didn't have a big spread between the open, high, low, and close, that made the pivot points for Wednesday pretty close to each other. So it didn't take all that much to hit R3 at 60.82. And then we closed slightly below the high for the day. So we were up 0.61%. We did actually see a pickup in volume. So that's rather encouraging to have an update, to set a new all-time high, and to see an increase in volume there. So we are positive in the short, intermediate, and long term. As always, there are some concerns. We're going to be getting some employment data. It's already been coming out, and we'll get more of that as we go throughout the week. And what will that do to inflation? What will that do to interest rates? What will that do to the Fed possibly cutting rates coming up later in the month? An awful lot of geopolitical things going on right now. South Korea, of course, the Middle East, Russia, Ukraine, different things happening inside the US as well. But the market's just kind of, we're going to go up anyway. We're going to feel real good about things, even though there's a lot of tension going around, not only in the US, but globally right now. All right. The S&P, the Dow, that's DJX, the Nasdaq and Nasdaq 100 did close at new all-time highs yet again. And mega caps, and this time I can include semiconductors in the list. They had a pretty good day, and growth, that's really what led things higher. And then we had Chair Powell coming out, and his comments were taken as positive, where he has some confidence in the U.S. economy and says, it's really performing strong right now. We have low unemployment and there's being progress made on inflation. And he said that the Fed is very cautious to monetary policy and they're trying to maintain this balance between the labor market stability and inflation. And that, it's kind of a balancing act. And the US is a huge economy, so and everybody criticizes, no matter what you do, somebody's going to come out and say, "Oh, he doesn't know what he's talking about." Well, who knows? I mean, but the Fed is a big part of the U.S. economy, and it's really has an impact on the stock market. So the stock market pays attention to that. And then there's been some things flying around where, it was Trump that appointed Powell, but and it's supposed to be an independent part. They're not supposed to be politically motivated one way or the other. And he just came out and said, okay, we are independent and we're going to continue to have this relationship with the Treasury, which that is also a presidential appointed person that will be running that. And there are going to be some changes. And so you've got all this stuff flying around about good, bad. Is it going to change? Is it going to be better? Is it going to be worse? And what have you. We still have a non-confirmed Hindenburg omen, and the VIX was up on an up day. We don't see that usually on an up day, especially when we're setting an all-time high. We typically will see the VIX go down. Well, it actually went higher in Wednesday's session. And we're getting our usual list here in the short term, looking either extreme positive or showing good short-term momentum with the CMB composite. Usually I include that in the intermediate term list, but usually with this chart, it doesn't stay here for very long, but it has been here for a few days. The Stochc RSI, Williams percent R, CCI 14 and 20, and stochastics. These are the main short-term indicators that we follow. And when we do start seeing any kind of a move, either up or down, this is the list usually. Where RSI 9, that's a shorter term momentum oscillator there. It's looking a little extreme, but doesn't come on the list all that often. And we're still getting kind of far away from the 20 period moving average. That's what the boom indicator measures. When we get too far away from that moving average, we have a tendency to come back to it. In the intermediate term, we also have the boom 50. We're getting kind of far away from that 50 period moving average. The Sean trend meter, which has been on this list for a while, it was the only thing on the intermediate term list. Now we're seeing a little of extreme action with the standard deviations chart. We're getting up into that +3 channel. Now we can stay up there. Doesn't mean we're going to reverse, but this is when we get a little bit concerned more in the intermediate term. And then we have the bullish percent index for the S&P and NASDAQ 100. They're giving us positive readings, and it's starting to go back up for the S&P and NASDAQ, but they're in that extreme area where we just want to be aware of that as well. The percent B indicator doesn't tend to happen very often, but we closed a little bit outside of the upper Bollinger Band. I already mentioned the Boom 50, and then we have the intermediate term RSI based on 14 periods. And no changes yet to the current scenario. The economy seems to be doing okay, and the market liked that the reports that did come out were weaker than expected because they were starting to become stronger than expected. And that puts more doubts about can the Fed come in and actually cut rates. The market has a little bit more confidence now because the data that I'll go through here in a moment wasn't as strong as feared. And the dollar was down. Interest rates were also down. We saw a pretty big drop here. We closed at 4.18% with the 10-year yield, where yesterday we were at 4.22%. And we're still inverted with the 10 to the 3 month, and the 10 to the 2 is still uninverted again. After the week of Thanksgiving on Monday, we actually went back to being inverted again, but that only lasted for one day. And we're going down with sentiment too. We're seeing the VIX going up, but we're seeing the sentiment gauge actually going down. And typically on an up day, sentiment will go up, and on an up day, the VIX will go down. We're just seeing the opposite of that right now. We're still positive, but the context is that we're declining here. We're at 57 where we had been at 62. We are positive with the trend. We're above the moving average. We're above 20, and the green line's on top. So we're dealing with a positive trend here, and with the up day, our bias is positive, and then the last number of days taken together, that's what I show as momentum. That is positive. Okay, and then we had the weekly MBA mortgage applications index, 2.8%. It was up. Last week it was up 6.3%. And this is one of the weaker than expected reports that came out with the ADP employment change, which is just the opposite of what we saw in yesterday's session with the JOLTS job openings. It came in stronger than expected. This one's coming in weaker than expected at 146,000. They expected 170,000 and down from the 184,000 that we saw last time. And this doesn't have much of an impact here with the S&P Global US Services PMI. The final reading here, the takeaway from this is it's above 50. All right, and it's up from 55. When it's above 50, that shows expansion. Now we're seeing a contraction in manufacturing. That's below 50. But here with services, we're seeing a continued expansion. And the big one was the ISM non-manufacturing. Again, you could say non-manufacturing and replace that with services. It came in at 52.1, which is above 50, showing an expansion, but less than the 55 and a half they thought was going to come out, and also down from the 56% that we saw last time. And this is what the market kind of liked, is that, yeah, okay, it's still above 50, so it's expanding, but it's also weaker than expected. Factory orders were up 0.2%. Last time they were down 0.2%. So here are the weekly MBA mortgage applications. Positive, but a decrease from the previous week. And here's the ADP employment change. Also positive here, but coming down from the previous reading. And factory orders year over year, just going up a little bit. We've been chopping right around this zero level, but in the latest year over year calculation, we are back to looking more positive. Durable goods year over year also saw an increase there. Non-durable goods, a little bit above zero with that. Non-defense capital goods, you need to take out aircraft, also a little bit above zero. So it's showing some growth there on a year over year basis. Then the ISM, there we look at the blue line, which is the total, and that came down. That was weaker than expected. A little bit of a concern, though, is that prices, the yellow line, that's continuing to go up. And then Isabel Net, some blog charts that I found here. This is the MSCI World Index right now. And if you take all of this and figure out, okay, which country has the most weight in the world index? Of course, the US at 67%. Then I like the other, okay? But then you have other bigger countries as well that also have an impact. Probability of a U.S. recession in the next year, according to Bloomberg, that's 25%. The market implied probability is at 23%, and then the Goldman Sachs is thinking it's 15%. Now, I have heard talk here and there. Some people that I kind of, okay, I take what you're saying, but you've also said some crazy things before, and that turned out not to be true. But then other people that I do listen to that say, okay, that I do respect think that we might go into a recession, but then other people that I listen to that I respect also still suggest that we won't go into a recession. So what do we do when we're faced with that? We follow the charts. We follow the information. Okay, the data might be manipulated here and there might be revisions that could come in and change the overall scenario. But we look at the data that we have and then just adjust things on an as needed basis. Then first, final quarter usually bodes well for stocks. This is just looking, this is a Bloomberg chart, looking over here at the fourth quarter performance, and it looks good there. Of course, when you're setting all-time highs, you notice that these charts tend to be positive. When we're going down, that's when these charts tend to be negative. Disinflationary progress on U.S. core PCE deflator has stalled. Okay. And I'm not sure what a trimmed mean is. Okay, I know what a mean is, and I know what trimmed is, but I'm not sure what a trimmed mean is on a year-over-year basis. That's the blue line. It's kind of flattening out here. When then we look at the year-over-year core, and that's really what we're following, where it's starting to go back up a little bit here. And then this is Deutsche Bank's baseline economic forecast. You may want to pause this just to see what they're coming up with. This is their forecast for real GDP. This is PCE, the headline number, and then core PCE, what they think is going to happen, the unemployment rate, and then the Fed funds rate. So again, this is kind of like predicting the weather. If you say it's going to rain tomorrow and it's sunshine, you're like, oh, I kind of messed up on that one. And these things change all the time, and they don't necessarily know things that we don't know here. So just kind of take this for what it's worth. And then risky versus safe asset fund flows. This could actually be a little bit positive for the market. We're seeing a pickup in folks getting into more risky. When we go above this line, that's when there's more getting into riskier. This is growth. This is where the risk on, risk off ratio really goes up. Well, it's coming back up as we're improving and setting all-time highs, but we're not getting a really extreme reading right now. So this could actually be more positive, meaning that, oh, okay, we're willing to jump in more to some of these riskier assets, which could help the stock market to go up. And Chinese tech stocks miss out on Wall Street's AI gold rush, where we have the NASDAQ 100 in blue here, which is setting a new all-time high. This might be a little outdated. And then they're comparing that to the Hang Seng Tech Index here, where it's really kind of falling behind a little bit. And then I did spend a little bit of time on Twitter. This is the rolling 4-week flows into equity, ETFs, and mutual funds. We're seeing just a gargantuan number going in right now. A lot of money is going in there as we're getting set to close out 2024. And then the median year over year change in annual pay. Thought this was kind of interesting. If you're changing your job, well, usually a lot of times people change a job as they get an increase in pay. And so that's starting to go back up after it had been declining. And then this is going back up just a little bit here with the people that actually stay at the same job. And then the Chief Financial Officer survey optimism indexes, and they have it on a scale here. We're looking at optimism about the U.S. economy. That's the red line. People are feeling better about that, according to CFOs. And we're also seeing an improvement here with the optimism about their own company as well. So feeling a little bit more positive about grass is greener on the other side when they compare it to their how they look inside. And the shaded areas here are during an election year. And I wanted to say that because a lot of times these shaded areas mean that's a recession. Okay, forward first quarter average analyzed total return. This is kind of interesting here. It says when the government takes on more debt, that's when the economy and the stock market tends to do better. And the largest deficit, this is when things perform better as well. And when we have the smallest deficit, that's we still do okay, but it performs less here. And that's, you've got all this debt out there, and a lot of that finds that way into the stock market. And so that really helps things have better returns. And this goes back to 1947. And then JP Morgan client long position surge. A lot of people that have their accounts at JP Morgan, they're throwing their money into the market right now. And then one thing, this actually came out yesterday. A gentleman named Art Cashin. And I really enjoyed him. And it was probably the only reason I ever watched CNBC. But 20 years ago, 25 years ago, when I was really into learning more about this, actually close to 30 years ago now, I would watch CNBC. It would be the first thing I would turn on in the morning, and usually the last thing I would turn off in the evening. And I lived for him. He would come in, and just for a couple minutes, he would just give little tidbits. And I don't watch financial media now, and actually that improved in my own personal perception of the market. I really don't watch other videos. There's a couple, especially weekly ones that I do watch. I don't watch Bloomberg. I don't watch CNBC. I don't watch Yahoo. I don't watch Fox Business. Um, I just feel that most of what they give you is completely irrelevant, if not wrong. And for the kind of ways that I analyze the market, it just doesn't seem to help. But this gentleman was one of the best. And I really would watch like hours of irrelevant and useless information just to see him coming on to CNBC. And he passed away, and there's been a lot of posts on Twitter about that. Okay. All right, here is the chart. You can see this looks like a pretty big gap, but just Monday and Tuesday, you can see the ranges weren't all that big here. between the open, high, low, and close. And so we were able to get up above R2 right off the bat. And it wasn't that big of a percentage move either, but it looks like a big gap here. And we held on to those gains. There was some choppiness right after the open. Then we drifted up to the 60.75 level and we kind of just stalled right there. Then it looked like, okay, we're going to come back down. We came back down to R2. And then this is when the smart money came in and said, okay, we're buying. And we went back above the moving average here. We bounced up off of R2. We got above R3, set the high right near the end, but then saw a little bit of selling going into the close. So we just ended up closing slightly off the high there. And seeing a little bit of a decline. It's pretty much flat in the initial overnight session. But this is another one of those sessions where right as we got closer to the open, that's when we saw the pre-market open futures really hold up and we were pretty much flat. And then Europe was having a pretty good day. And then we just carried that over into the cash session. But a lot of the strength was actually in the day itself. And we're seeing this improvement. This is the intraday chart of growth versus value with the blue line above the red line. We like that. And they both can go up. We just want the blue line to be going up more. And that's usually when the index performs better. Seeing an improvement here. Going back to the latter part of November where we bounced up with the growth to value ratio intraday for the S&P. That's encouraging as well. And we were up with growth where value was actually down, even though we set a new all-time high with the S&P. And at least over the last couple of sessions, we're seeing more of a favor towards growth. And that's why the indexes are doing quite well. We were up more with the mid caps and we were up, but up about half as much, even less than that, with the small cap growth versus value. So with our end of day charts here, we are improving with the growth to value ratio for the small caps. Saw a big improvement here with the mid caps. And we're starting to break out finally here when we look at S&P growth to value. That's encouraging, and that's what we would like to see. And we're seeing a real improvement here between the growth and value ETF, just shooting up out of the rainbow again. And discretionary to staples also coming in and looking pretty solid right now. Large cap growth setting a new all-time high. And as far as our trend, we're above the moving average. We're above 20. The green line's on top and going up. So in the intermediate term, that's positive. Here's the short-term trend where we're also looking positive here. And we did pick up. Now the oscillator, it takes like days together. That's why we're still below zero here. But we did have an above average volume day. And this is similar to a chart that I show over the weekend where we look at the active asset managers and it says professional managers buy tops and they're getting kind of high readings right now. And I'll be going over this over the weekend as well. They're emotional. I mean, they have client pressure, they have peer pressure, they've got this idea, oh my gosh, I was looking at this stock and I didn't get into it, but now it's really going up, so I better jump into it now because they're trying to constantly outperform the indexes, which most don't, but they're trying to do that. And so there's emotion involved in all of this as well. And then positioning on S&P 500 is very extended, according to this Bloomberg chart here. This is another take on the active asset managers and where they're positioned and what the S&P is actually doing. And then we did get the latest reading of Investors Intelligence. It was a little mixed up last week because of Thanksgiving, coming in at 3.91. Now we're getting to a pretty high reading here. We're going to get even more concerned if we go up above that 4 level. But this is looking pretty positive, but maybe a little too positive right now. But it could still go higher. And we actually went up a little bit here with the VIX on the line chart and the bar chart. And we declined a little with the VIX of the VIX, though. And even though we were up with the VIX, we're getting in 13, which is when you get to the 12 to 13 range, that's according to the Tom Bowley research. And sometimes I show that chart in the weekly videos. That's when we see the positive annualized returns. And Tom Bowley works with stockcharts.com. He also has another website called earningsbeats.com. I have no relationship with him other than I get his emails and I watch a few of his videos from time to time. But this is when we see the best returns on an annualized basis for the S&P when the VIX is actually coming down, even though it went up in Wednesday's session. But the momentum of the VIX is still down. And this is what we're seeing also. This is part of the positive seasonality. As the VIX is going down, stocks are going up, but we're still getting a really high reading here with the skew index, which is a variation of the VIX. The VIX uses at the money options to be calculated. The skew index uses out of the money options. And we're coming in with a quite high reading that the market is still expecting some kind of a big move that hasn't happened yet. Whether that's going to be to the upside or the downside, we're not quite sure. And we declined with this fear gauge where we were actually up with this other fear gauge. So a bit of a contradiction there. And I haven't shown this in a while because we've been just chopping around like on a treadmill. But the risk on to risk off ratio is starting to go back up. And that means that folks are getting into the riskier stocks when compared to the equal weight version of the S&P. And so when this is going up, that tends to also do better for the indexes. And looking at the broad market here, this is a 5 period moving average of the highs and lows. It's coming down a little bit because we're seeing a little bit of broader market weakness right now, but we're still well above zero and looking positive. And this is longer term. And this is also longer term, but applies to the S&P. The 10-day average of the highs and lows here, we're above this green line and going up, which is where we've spent most of 2024, which suggests good longer term momentum. And we declined with the daily chart of the equity put call. We're still going up with the 5-day chart of the equity put call ratio. This is just to give a bigger picture and more of a focus on the longer term. And we're still declining with the 10-day average though. So we're seeing a little contradiction there. The 5-day going up and the 10-day going down. Still not seeing a lot of fear as measured by the volatility risk premium. So that kind of goes in hand with the low reading of the VIX that we're seeing right now. And this is a little bit of a concern here because it just means the rest of the S&P is not really participating in setting the all-time highs like the bigger stocks are. So we're seeing a bit of a decline here with the advanced decline line based on price and volume. And we've seen that over the last couple of sessions, even though the S&P continues to set new all-time highs. But longer term, we're still looking good. We're well above this advancing moving average with both price and volume. And saw a little bit of an expansion of the new lows here, but also an expansion of the new highs. That's another internal measure. So we're still going up with the 5-day and we're going up slightly, but it's leveling off with our 10-day moving average. And we're getting possibly a little extreme here with accumulation distribution. It's positive. We're well above an advancing moving average, but we're kind of getting a little far away here as measured by the boom indicator. And we're actually declining with the advanced decline ratio, but we're still above zero. Okay, so that's part of the weakness that we're a little bit concerned about here. And we came down just a little bit with the histogram on the Chaikin money flow, but overall, this is still positive. And we're going back up now, where we've been a little concerned about the Chaikin oscillator. It was going down when the S&P was going up. Now it's going up and getting above this red line. Now, again, it could still go higher than where we're at right now. We just get a little bit concerned when we get above this red line, but it's positive. And we're seeing an improvement here with the vortex, the green line going up with the red line going down. But when you look at the cumulative advanced decline line based on price, nah, we're not setting an all-time high there, either based on price or volume. And we're seeing a little bit of a disconnect here as the bar chart, which is the S&P, it's going up as the NYSE advanced decline line is actually coming down slightly. And we're also seeing that in the broader market. The cumulative NYSE advanced decline line, it's down, still above the moving average though. And our regular NYSE advanced decline line also came down, and this other advanced decline line also declined. So it's more broad market. We're not seeing the strength that we're seeing in the S&P right now, specifically related to the mega caps, semiconductors, and the large caps. And also not really showing much of an improvement, actually a little bit of a decline here with the NYC common stock based on price and volume. And so our advanced decline line, was flat here with the NYC common stock, was flat with the S&P. Mid caps saw a little bit of a tick up and a little bit of an improvement with those small caps as well. And we're not extreme anymore with those stocks inside the S&P above their 20-day moving averages. When we get above this 80 level, we're getting a little extreme with that. It's really starting to come down. Then this next chart, usually 70 is when it's showing good short-term momentum while we're dropping back down below 70, even though we're setting an all-time high with the S&P. So we're declining with the 50-day moving average study, the 100 study, and the 200 study, but they're all still positive. And here we go, setting an all-time high here, and we actually came up a little bit above the moving average. When we look at volume, and we're declining with the 20, 50, and even a little bit with the 200-day moving average on the S&P. But our short-term indicators, the Stochk RSI is extreme positive, as is the Williams percent R, CCI 14, and the CCI 20, and all of our stochastics in the short term, intermediate short term, and long short term. And we're above zero and going up with the force index. That's positive. The condition of the short-term trend above the green line and the blue line and setting a new all-time high there with the lines going up. And our simple and exponential moving averages based on 20 periods also looking really solid currently. But we're getting up into this +3 channel with the standard deviations chart. And we can ride this for a while. We rode it earlier in the year and stayed up here for a number of days. We'll see if something like that's going to happen this time. We just want to be a little bit more cautious when we get up to this really high reading. Intermediate term, going back up and looking positive with the balance of power. Here's the chicken, or excuse me, the CMB composite, and we're above the line here, suggesting we're extreme. The condition of the intermediate term trend based on 50 periods looking really good with the red line above the blue line, and both are going up. The go, no go continues to be dark blue. That's positive. The highest high value continues to go up. That's positive. But we're still seeing a decline here with the TTM squeeze. It's more like a negative divergence. The S&P is going up, but the TTM squeeze is going down with the darker blue bars and going back up and slightly above zero with the ease of movement. The Erin indicator showed a little bit of improvement where we're going back up with the green line, that's buyers, and coming down with the red line, that's sellers. The difference between the two is the oscillator. It's going up and above zero, so that is positive. And we're still below zero with the S&P McClellan oscillator. So that's one of the warning signs that we're watching. This is more short to somewhat intermediate term. And then we're starting to roll over with the summation index based on price and volume. And that's more intermediate to even a little bit long term here. And we're concerned about this. This just means that not all of the stocks in the S&P are participating right now. Uh, But we're still positive when we look at the NYSE McClellan oscillator. However, we are declining, but we're still above zero here. So we continue to go up with the summation index based on price and volume for the NYSE. This is another warning sign that we're getting right now. The Swenlin trading oscillator, as we've been going up with the S&P based on price and volume, we've been declining with this. Now, sometimes this gives us a heads up. But there have been times when this indicator will give us some false signals. That's why we don't want to use it in isolation. Momentum, though, is still positive with the PMO, but if you break it out based on price, seeing a little bit of weakness here and a little bit of rolling over based on volume. The PMOs that are rising are actually going down with the S&P setting an all-time high. The buy signals are still going down, and we're starting to trail off just a little bit with the PMOs above zero. And this is our one kind of outlier short-term oscillator, the slope oscillator. It continues to decline below its moving average. But all of our other oscillators are still looking positive, like the MACD, looking pretty good right there. See the slope? It's going down with the other short-term oscillator, the TSI, it's continuing to go up. We're going up with the intermediate term, the MACD, the PMO, and PPO, and we're going up with the long-term TRIX and KST. And we're improving, but we're still negative with the Copic curve. And we're coming down, but still looking pretty positive here with the Sean trend meter. Flat, but above 50 with the money flow. Going back up with the ultimate oscillator, above 50, that's positive. Unbalanced volume just keeps going higher here. And we're just a little bit above this upper Bollinger Band. That's why the percent B indicator here, which there's books written on how you can use Bollinger Bands. This is just one use of them, is when we get up above this upper Bollinger Band, that maybe means that we've gone up too far too fast. Now, what's going to happen? Because this tends to not last very long if you go back and look at other times. Now, it can last a few days, but usually what we'll see is either a decline in price or an advance in the Bollinger Band or a combination of the two that will end up working off this extreme reading. And here's the RSI 14, just a little bit above 70. So that's barely extreme positive there. a little bit higher reading here with the RSI 9. And the Pring bottom fisher, which again turns out to have given us a pretty good buy signal there that was generated even before we started to go up. But I wouldn't necessarily rely on this. What the signal that we're getting right now is not really what this was designed to do. It's just kind of a fluke. But we've seen this from time to time as well, where it gave us a pretty nice little signal. And we're positive with the Elder's Impulse system for the S&P. We have the dots underneath, so that's positive with the parabolic SAR. Getting a little far away from the 20 and 50-day moving averages here as measured by the boom indicator. Looking really solid with our moving averages, and all the lines continue to go up. Bullish percent index continuing to go up. Now it's above 70. It's a little bit of a concern there, meaning we're getting extreme, but we could still go higher than where we're at right now. And it actually came down just a little bit, but not much here with the NYSE bullish percent index. And we're going back up and looking extreme with the NASDAQ 100 bullish percent index. And then longer term, going back to 2009, this is a trend channel. We're coming right up here. We're actually trying to go a little bit above this line right now. Now, we got above it back in 2021. Are we going to get above it here? Or is this going to work itself out as being longer term overhead resistance? But we look at the trend though, with the Heiken Ashi, we are positive with the open candles. We're pointing up in black with the Kegi chart. That's positive. The Renko chart has open blocks. That's positive. And the three-line break has open candles or bars. That's also positive. And I'm not showing any long-term charts now. We're mainly focusing on the short and somewhat intermediate term. Still positive across the board with the Keller market model on all time frames with all indexes. No changes here. Still negative in the intermediate term with bonds based on price, with commodities being negative. And the areas that we want to see doing well did well. We have tech, discretionary, and communication. They were up, and that's what helped the S&P to go higher. A lot of the other sectors ended up being down, with energy being down the most. And seeing a lot of, well, a little bit of a Christmas look here. Canada setting a new all-time high. The S&P and NASDAQ with all-time highs. The euro went below 105 only to come back above it later in the day, with the Dow setting an all-time high. Utilities, this is a bearish MACD crossover, which that can often be a more defensive area. So that would actually be positive. Healthcare was able to get back above 50 after it's seen some difficult times. And tech is crossing below 70. That's a little bit of a warning sign to us as well. And coming in and setting a new all-time high with the S&P and the NASDAQ. So that's a confirmation according to this new take on Dow theory. Traditional Dow theory, we're not seeing a confirmation right now. The transports were down as the Dow was up. And we're not quite at a new all-time high here with the equal weight S&P, but we are at an all-time high with the equal weight QQQ, which is the NASDAQ 100. Seeing a little bit of a disconnect here as the S&P is going up, but the equal weight is actually going down. This also is looking at the ratio between the two. We've been chopping around so much, so I stopped showing this chart. Well, we've been seeing a real pickup here, and that just means the bigger stocks are outperforming. And we have the Dow setting another all-time high, but we're still neutral with the Elder's Impulse system. And we're actually closing a little above this R1 level. And that's encouraging because these pivot points seem to be important for the NASDAQ. So we're just a little bit above that. You might call it still not necessarily resistance that we've cleared with too much yet. And also right about on the line, a little bit above it with the NASDAQ 100, also setting another new all-time high. We're positive with the Elder's Impulse system with the Qs. The momentum is now turned back to positive for the NASDAQ 100. Small caps, they were up, but only 1/3%. Still looking solid here with the Russell 2000 small caps, going back up with the RSI, and we're actually still rolling over, but positive with the momentum. And we're neutral with the Elder's Impulse system for the small caps. Mid caps were up 0.28%. You see how both small caps and mid caps underperformed. Continue to be neutral with the Elder's Impulse system for the mid caps, setting an all-time high with the Wilshire 5000, setting an all-time high with the total US stock ETF. And I haven't shown this in a while either because we've been just chopping around here, but we're really going down again with the staples to tech ratio. And that's positive. When this goes down, that means staples are underperforming tech. And if you're positive on the tech sector, you want this ratio to go down. And we're also seeing a recent death cross here with this ratio, which means the trend is also down. Financial sector still seeing a little more profit taking here, but looking pretty solid altogether, setting an all-time high with the FANG index. These are the real big companies: Facebook, Apple, Amazon, Netflix, Google, Nvidia, blah, blah, blah. And coming up, but not quite to the shorter term trend line here with the FANG index. So Apple was up 0.15%, setting a new all-time high there. Amazon was up over 2%, setting an all-time high. Microsoft still doing a good job of bouncing up off of its 50 and 200-day moving averages and showing a real improvement there. Google was up 1.77% and looking a little better now. Meta setting another new all-time high, even though it was only up 0.02%. And Nvidia up almost 3.5%, not back to an all-time high, but coming up off of its 50-day moving average. Tesla was up 1.85%, but not at an all-time high again yet. Netflix is setting another new all-time high. And I guess we have Bitcoin finally went over the 100,000 level. And that was a lot on Twitter or X. Everyone's all crazy about that and felt they had to post something about that. And the shorter term correlation is actually improving here between US and world stocks. And we're seeing a little bit of a pickup now with the longer term correlation where they have really been deviating from each other. We're keeping an eye on the semiconductors. We were up 1.3%, but we're still below the 50 and 200-day moving averages. And we've still generated a recent death cross here. We want to get back above both of these lines, close above it, and see these lines turn back up. And we're not seeing that yet, but we are at least going up for the time being. Oil's actually dropping, even though we've got things going crazy in Syria and there's a kind of a broken ceasefire going on in the Middle East. But oil it was down 2%, dropping further into the 60 range now. And we're seeing a recent golden cross here with the dollar after it's been really strong lately, even though it was down. Now it's going to stay up here because this trade's 24.6, and this is just what it was at the time I took this chart. We were down to the 50-day moving average with the 10-year yield. This would be more encouraging and more helpful for stocks if we could drop down below this 50-day moving average, and we were up a little bit above the 50-day moving average based on price. And we're seeing real improvement here with the Qs to S&P above the moving average, discretionary to S&P looking solid. More improvement here when we compare large cap growth to large cap value. So even with the mid caps and small caps, they underperformed, but their ratios are still showing a real improvement headed towards growth. And that could help all of the indexes. Haven't shown this in a while. I used to show this every day. We're kind of starting to go back down now when we look at the staples to S&P ratio, and that's actually positive. That means staples, which are more defensive, are underperforming the S&P itself. So what's our outlook for Thursday? We're still positive with positive seasonality. Haven't changed that. Of course, you can't get much more positive than setting an all-time high. That's not necessarily looking like a blow off top, at least right now. We're going to have the initial jobless claims as well as continuing claims in Thursday's session, the trade balance and factory orders. The big one is probably going to be the jobless data that's coming out because then we have the employment situation report on Friday. The whole list of crazy stuff going on in the world, but the stock market's like, hey, yeah, we're in good, cool times right now. And then we'll have the employment report on Friday. And this is what the previous readings were and what the forecasts are for those reports. Seasonality neutral to positive with the Dow, and we're flat out positive with the NASDAQ, going back roughly 21 years or so for that. And here comes all the different seasonal charts here. Another clue, December will be strong. Yeah, all right. The final 6 months when we're up over 10% at the midpoint of the year, going back to World War II, we're up 100% of the time. Try to tell the perma bears that. And here's another one. Stocks up 5% in November. That's also a good sign for December. In here, and December is rarely the worst month. Only one time it was the worst month going back to 1928. Must have really been a bad Christmas that year. And here is the seasonal chart where we do have some positive seasonality during an election year. That's the green dashed line. A few days before it gets a little bit choppy for a few days, probably going into next week. And when we look at from Thanksgiving to the second day of the trading year, the new year, we're up a lot more, almost 80% of the time with the S&P, up almost 78% of the time with the small caps. And this is what's been happening in 2024. And you compare it to these other averages here in aggregate cycles, and we're just blowing them out of the water. Thursday is a positive day in 2023. It's also a positive day so far in 2024. Here's another seasonal chart looking good going forward as well as after the election. And this is what happened after 2020, after the election. All right, so we're still going down with the equity put call ratio based on 10 periods there. That actually should be changed. And the McClellan oscillator and summation indexes. We're concerned about that because we're below zero with the McClellan oscillator, which is turning the summation indexes down based on price. And we're also starting to go down based on volume. That's a concern there. The Copic curve is still negative, but improving. And we have a non-confirmed Hindenburg Omen. All right, then positive side, we got a pretty long list here. We look at our three smart money indicators. We're getting kind of extreme with accumulation distribution. The chicken money flow, not necessarily extreme. It did come down just a little bit, but it's still positive. And the chicken oscillator could be getting to that extreme level currently. So we're positive, but just kind of keeping an eye on those. We're going down with the 5 day. And the NYSE McClellan oscillator and summation index, those are still positive, even though they have been declining. And the Swenlin trading oscillator, a little bit concerned there. We're actually in danger of dropping below zero based on price, and we're declining also, but still positive based on we're still positive based on price there, but we are declining. The vortex is improving. We're looking pretty good right now with growth to value and discretionary to staples. Our oscillators are positive except for this slope oscillator that's below its moving average and declining. Not really seeing an awful lot of strength in the advanced decline line right now, but it's not really breaking down either. It's still above all their moving averages. We're still looking positive even though we're declining with our moving average studies. The parabolic SAR and the bullish percent indexes continue to be positive. A little extreme with the S&P and Nasdaq 100 there. The ease of movement, money flow, and ultimate oscillator, again, secondary indicators in my opinion. They're positive though. And we are looking more positive with the momentum of the Nasdaq 100 as measured by the PPO. And the financial sector, even though it's been coming under some pressure over the last few sessions, it's still looking pretty solid there. No update here other than to change the day. No confirmation yet with the Hindenburg Omen, and we have until December 19th for that to happen. Our conclusion, we're positive with positive seasonality, but we are a little bit concerned about some weakness that's coming in to the market. In the short term, we're positive with positive seasonality as well. And we're positive, but this is where we're seeing more of the weakness in the intermediate term, and we continue to be positive in the long term. Thank you. I really hope you found this helpful, and I hope you have a great day, and I will talk to you in the next video.